In 2001, Enron was the seventh largest corporation in America. In 2001, the momentum stopped. Enron filed for Chapter 11 bankruptcy. Glass and steel in Houston, a small group of executives had spent years architecting a financial structure. To scale this vision, Lay hired a mastermind who understood the complexities of trading. A Harvard MBA and former McKinsey consultant named Jeff Skilling. The gap between these fake profits and Enron's mounting real-world losses required a specialized architect. That role fell to Chief Financial Officer Andy Fastow. Summer of 2001, Vice President Sharon Watkins was reviewing corporate assets when she discovered the web of shell companies that Enron was about to implode in an accounting scandal that would destroy the company. Arthur Andersen's Houston office, auditors began a desperate attempt to destroy the evidence. They ran shredding machines around the clock to eliminate thousands of documents before investigators could arrive. Billions of dollars vanish from a corporate balance sheet. The architects of the collapse rarely face a ruin equal to the damage. Enron collapse was a painful but survivable legal hurdle. They paid fines, served reduced sentences, and moved on. Congress was forced to step in and draft entirely new legislation to close the loopholes that executives like Fastow and Skilling had so easily exploited. Financial structure was intentionally complex, built so densely that analysts couldn't figure out where the actual revenues. Financial engineering was designed to obscure a terrifying reality. Leadership didn't have answers because the profits weren't real. Creating phantom revenue and burying the resulting loans required external validation. The deception survived because the systems designed to audit corporate finances collapsed, eroding the boundary between legitimate success and criminal fraud until the perpetrators can no longer tell the difference. Very few modern whistleblowers to expose a massive corporate crime and emerge without facing retaliatory action from her employees. 2001, Enron was the seventh largest corporation in America. Fortune magazine named it the country's most innovative company for 6 years running. Its stock sat comfortably at $90 a share, and Wall Street viewed it as the leader of the energy sector. The company's influence reached into the highest levels of government. Its CEO, Ken Lay, helped the administration draft United States energy policy from inside the White House. On December 2, 2001, the momentum stopped. Enron filed for Chapter 11 bankruptcy. In a matter of weeks, the $90 stock price vaporized, bottoming out at just 26 cents a share. The human toll was immediate. 20,000 people lost their jobs. Looking at these employees carrying their boxes, you are seeing people whose 30-year retirement savings, tied up in Enron stock, vanished in a single afternoon. The bankruptcy filings revealed a massive disconnect between Enron's public image and its internal finances. While the company reported billions in earnings, the actual cash flow to back those numbers was missing. Behind the glass and steel in Houston, a small group of executives had spent years architecting a financial structure built on hidden debts and fabricated profits. It started with Ken Lay. He took a simple natural gas pipeline operator and capitalized on government deregulation, which allowed his company to sell energy at market prices rather than government-controlled rates. To scale this vision, Lay hired a mastermind who understood the complexities of trading, a Harvard MBA and former McKinsey consultant named Jeff Skilling. Skilling joined Enron on one non-negotiable condition. The company had to adopt an accounting method known as mark-to-market. This diagram shows how the method works. If Enron signed a 20-year energy contract, they didn't wait for the money to arrive. Instead, they projected the total estimated value of the next 2 decades and recorded all of it as profit on the very first day. The risk was obvious. If the actual revenue fell short of the projection, Enron still had to report the high number to satisfy Wall Street. As we can see, the reported profit bar stayed high, while the actual cash flowing in was only a fraction of that amount. Skilling maintained this system through a rank and yank policy, where the company fired the bottom 15% of its workforce every year. This forced employees to prioritize high numbers at any cost to protect their jobs. By recording projected revenue as immediate cash, Skilling provided an appearance of infinite growth, while detaching the corporation's books from the movement of real money. Managing the gap between these fake profits and Enron's mounting real-world losses required a specialized architect. That role fell to Chief Financial Officer Andy Fastow. Fastow created a labyrinth of shell companies called Special Purpose Entities, or SPEs. He gave them aggressive code names like Raptors. As this structure shows, the SPEs acted as a dumping ground. Fastow took Enron's failing assets and toxic debt and moved them into these entities. The losses were swallowed by these hidden entities, leaving Enron's public balance sheet looking pristine. Fasto also served as the managing partner for these shell companies. He essentially negotiated deals with himself and personally pocketed over $30 million in management fees through the entities he created. The final line of defense against this fraud was Arthur Andersen, the external auditor hired to independently verify Enron's financial health. In 2000 alone, Arthur Andersen received $27 million for its audit and another $25 million for consulting services. The firm had a $52 million incentive to ignore the irregularities it found. The deception continued because the internal architect was skimming millions, and the external watchdog was being paid tens of millions to remain silent. In the summer of 2001, Vice President Sharon Watkins was reviewing corporate assets when she discovered the web of shell companies. She realized the entire corporation was an accounting time bomb. Watkins wrote a 7-page memo to Ken Lay. She warned him that Enron was about to implode in an accounting scandal that would destroy the company. Lay responded by turning the memo over to the company's own lawyers, the same ones who had approved Fasto's entities. They conducted a brief investigation and declared the finances were sound. The cover-up failed within weeks. Skilling abruptly resigned. Enron announced a $618 million quarterly loss, and the SEC launched a formal investigation. During the ensuing panic, Ken Lay held town hall meetings encouraging employees to buy more Enron stock. While they bought in, Lay was secretly selling $70 million of his own shares. At Arthur Andersen's Houston office, auditors began a desperate attempt to destroy the evidence. They ran shredding machines around the clock to eliminate thousands of documents before investigators could arrive. The fallout was total. Fasto testified against his colleagues. Skilling was sentenced to 24 years in prison, and Arthur Andersen collapsed entirely. Sharon Watkins was later honored by Time magazine for her role in bringing the truth to light. Enron remains a warning of what happens when corporate hubris is paired with a toxic culture. When the watchdogs are compromised and billions of dollars vanish from a corporate balance sheet, the architects of the collapse rarely face a ruin equal to the damage caused. Take Enron CEO Jeff Skilling. He was originally sentenced to 24 years in federal prison. High-priced legal teams know how to negotiate. In 2013, Skilling struck a deal. He forfeited $42 million and dropped his ongoing appeals. In exchange, his sentence was cut to 14 years. By August 2018, he was a free man. CFO Andy Fasto struck an even better bargain. He secured an initial 10-year deal and, after cooperating with prosecutors, walked out after serving just 6. Today, Fasto gives guest lectures at business schools and to fraud investigators. He actually brings his old CFO of the Year trophy and his Federal Bureau of Prisons ID card to the podium as props. The architects of the collapse treated the justice system like another boardroom transaction, securing their own freedom while leaving behind Fasto's chilling warning to his audiences. You can follow all the rules and still commit fraud. The massive institutions that enabled the fraud also found ways to absorb the blow. Enron's auditor, Arthur Andersen, was completely dissolved over their complicity, wiping out 85,000 jobs worldwide. Wall Street giant Merrill Lynch helped hide Enron's debt through a sham transaction known as the Nigerian barges deal. Their penalty amounted to convictions for 4 executives and a fine of $90 million, a fraction of the bank's quarterly revenue. This exhibit displays the specific red flags that were presented directly to Enron's board of directors. They had clear sightlines into the impending collapse, yet failed to intervene. The result was a $40 billion lawsuit from shareholders, who ultimately settled for a fraction of their losses at $7.2 billion. For the executives, the massive banks, and the auditing firms, the Enron collapse was a painful but survivable legal hurdle. They paid fines, served reduced sentences, and moved on. The true cost of the fraud didn't fall on the executives. The individuals who paid the ultimate price were the 20,000 Enron workers. The bankruptcy immediately vaporized employee health insurance, steady paychecks, and the basic livelihoods of 20,000 people. An agent on the FBI's Enron task force noted that seeing this human collateral damage is what kept investigators pressing forward, sacrificing 5 years of their lives to build the case. While executives were sitting in mansions negotiating plea deals, the workforce was suddenly left with nothing to trade or bargain with. The devastation was amplified by a specific mechanical trap. Enron aggressively promoted a policy where employees invested their 401k savings directly into Enron's own stock. Notice this line chart tracking the share price's catastrophic drop. As the collapse began, Enron imposed a lockdown period on those accounts, legally freezing employees from selling. Veterans who dedicated decades to the corporation watched their life savings dwindle to absolutely nothing. During that exact same window, Chairman Ken Lay was sending messages to the staff, actively encouraging them to buy more stock, claiming the company was incredibly strong. In reality, Lay was quietly liquidating his own shares, offloading $70 million worth of stock, while his workforce was locked out of their accounts. This was a deliberate, structural transfer of wealth. The executives fled with millions by ensuring the rank-and-file employees stayed trapped inside the burning building. The massive scale of those stolen futures generated a level of public outrage that the existing justice system was entirely unequipped to handle. When the telecom giant WorldCom collapsed under its own massive accounting fraud shortly after, the public realized Enron represented a failure of the entire national corporate system. Congress was forced to step in and draft entirely new legislation to close the loopholes that executives like Fastow and Skilling had so easily exploited. The old regulatory framework was too easily manipulated. Protecting the American worker required tearing down those rules and starting over from scratch. This document is the Sarbanes-Oxley Act, passed into law on July 30, 2002. It served as the definitive legislative response to the crisis. The act established strict boundaries. CEOs and CFOs must now personally sign off on the accuracy of their financial statements, making them criminally liable for any lies discovered. Section 401 mandated that all off-balance sheet tricks be clearly disclosed to investors. Meanwhile, Section 802 made the shredding of documents during a federal investigation a severe criminal offense. The law also dealt a final blow to Arthur Andersen's old business model. It explicitly forbade auditing firms from selling consulting services to the same clients they were supposed to be objectively reviewing, permanently ending that conflict of interest. A few executives went to prison and eventually negotiated their way back out, but the financial sacrifice of those 20,000 employees forced a permanent rewrite of Enron was the 7th largest corporation in America. For 6 years running, Fortune magazine crowned them the country's most innovative company. But inside the company, a vice president named Sharon Watkins was drafting a memo to the chairman. She wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals." Management received the warning. Instead of investigating her claims, leadership immediately consulted legal counsel to find options to fire her. Watkins had identified a glaring operational defect. The company's financial structure was intentionally complex, built so densely that analysts couldn't figure out where the actual revenue was coming from. When financial journalist Bethany McLean directly asked how Enron made its money, CEO Jeff Skilling refused to answer, opting instead to call her an asshole. The innovation the market praised was actually a structural void. The dense financial engineering was designed to obscure a terrifying reality. Leadership didn't have answers because the profits weren't real. This chart shows how Enron utilized mark-to-market accounting. When they signed a long-term contract, they estimated the total expected profit for the entire lifespan of the deal and instantly recognized all of it on the current day's ledger. The fatal flaw of this accounting method is the cash flow. They were recording millions in revenue on paper for deals that hadn't paid out a single cent, creating a massive deficit between the ledger numbers and actual bank deposits. This structural diagram illustrates their second tool, special purpose entities, or SPEs. To keep the market from seeing the cash deficit, Enron borrowed heavily and then moved that new debt off their primary balance sheet, parked inside these detached subsidiary boxes. Generating phantom revenue and burying the resulting loans required external validation. The deception survived because the systems designed to audit corporate finances collapsed. Arthur Andersen served as Enron's auditor, tasked with verifying the books, while simultaneously working as a consultant, helping Enron design those exact same financial structures. This conflict of interest meant rejecting Enron's math would cost Andersen millions in consulting fees. This chart details the timeline of the collapse, specifically tracking the red flags presented directly to Enron's board of directors. The board repeatedly waived its own code of ethics to allow the hidden debt structures, ignoring the internal warnings, while the stock price collapsed. A multi-billion-dollar deception cannot run on isolated bad actors. It requires a complete decay of structural oversight, turning the independent firms hired to catch fraud into the very mechanisms that enable it. Internally, Jeff Skilling enforced an evaluation system known as rank and yank. Every year, the bottom 15% of employees were automatically fired. To avoid the bottom tier, staff aggressively manipulated their performance metrics, prioritizing short-term, inflated numbers over actual, sustainable business. Chief Financial Officer Andy Fastow designed many of the deceptive entities. After serving years in federal prison for his role, he now gives lectures on corporate ethics. Fastow often notes that the bankruptcy itself is less compelling than the preceding decade of fraud. His core realization is that during those 10 years, the executives genuinely believed their actions were the right thing to do. When an entire workforce is terrified of termination, survival instincts take over. A punitive culture normalizes lying, slowly eroding the boundary between legitimate success and criminal fraud, until the perpetrators can no longer tell the difference. Sharon Watkins' warning of an impending accounting scandal proved accurate. The hidden debt became too massive to service, the stock crashed, and the illusion evaporated almost overnight. The liquidation happened so fast that human resources and legal departments were paralyzed. Leadership lost control of the company before they could even execute their plan to fire her. Because of that rapid collapse, Watkins stands as a historical anomaly. She is one of the very few modern whistleblowers to expose a massive corporate crime and emerge without facing retaliatory action from her employers. Stripped of its market valuations and press awards, the corporation was reduced to its physical assets, thousands of empty desks inside a massive Houston skyscraper. Most innovative is a subjective label, easily bought with aggressive public relations and complicit auditors, but financial ledgers are objective. Math will eventually reconcile. The numbers will always expose the deficit, but the damage can only be stopped if an organization's culture allows brave individuals to look at the math and tell the truth.